The macro is bloody awful. It's the largest, most concentrated tightening of rates that I think we've seen almost in history. We have the largest tightening of financial conditions on a broad measure, as opposed to, a lot of people use the Goldman measure. That's not that broad because it uses equity markets, and it's a weird kind of feedback loop between equities and that. But if what I did was use the rate of change of rates, the rate of change of the dollar, and the rate of change of commodity prices, and it gives you a understanding of how tight money is. The other way you can look at it is the number of central banks as a percentage of total central banks raising rates. Those kind of things give us a growth shock that is ahead, that we're starting to see, that is quite sharp and severe. So we're talking about something where, GDP growth falls 3% or so. So a really decent sized recession. But it looks like my forward-looking indicators suggest that the bottom of this growth shock comes actually pretty soon, like March 2023. And so if the bottom comes, then you get the recovery side. So, to David Rosenberg's point, it ends up being about 18 months or 2 years, because we probably started some sort of recession at the beginning of this year. So the macro is bad now and is going to get worse. The narrative you will see is, well, the macro is about to get terrible, all assets must fall. But once you start doing things like doing the year-on-year rate of change of the S&P or the NASDAQ, they're actually pricing in an ISM, the Institute of Supply Managers survey, of about 40. So that's pretty severe recession as it is. Could they price in a bit further? Could it be a one lower stab? Sure. But these are forward-looking assets. And what they look for is the turn. Why the turn? Because that's somewhere in the next 6 months, the central banks will most likely go, okay, unemployment's coming up, inflation's coming down. We have to look after, our mandates are unemployment and inflation. Inflation is going to be maybe stickier or higher. I don't believe it will be. I think it actually goes negative. But unemployment is going to be coming up. We need to at least stop. If the rate of change stops, right, you've stopped the pressure on markets. Now, it doesn't mean they explode higher. It's not 2021 all over again. But if the pressure stops because the rate change, because QT stops and they stop raising rates because they want to see how bad this is. Okay, so the probabilities then come of rate cuts, or if not, at least it's going to be stability. They're unlikely to raise rates higher. Okay, so that's generally good for risk assets because they're forward looking. So that's where it comes into crypto. So crypto is really interesting. Same with technology stocks, is they are in an exponential logarithmic uptrend because they are network adoption models. So in technology stocks, we've got the relentless, ongoing, ridiculous pace of rise of AI, robotics, EV, space, Internet of Things, 5G, 6G. Genetic sciences, all of these things are all coming together at the same time. It's the fastest pace of change humanity will ever go through. It's hard enough for us to deal with on societal level, but that's not stopping. Part of that is blockchain technology, digital assets. They're in the same exponential trend, but maybe even faster, because crypto with 300 million users is the fastest adoption of any technology the world has ever seen, twice the speed of the internet. So what you're thinking, so if you can visualize, is you've basically got this massive uptrend that is exponential in nature, but when you put it on a log trend, it's quite nice and smooth. But you've got these big swings. Those big swings are driven by the macro. So what we've done is we're at the bottom of the macro cycle. The beach ball is now being held underwater. But don't forget, every day there's new people building in the ecosystem, there's new adoption. People like Ticketmaster have issued 10 million NFTs without anybody realizing. The scale of what is happening is ridiculous. So the beach ball is held underwater. The moment quantitative tightening or rate rises stop, the beach ball rises above the water. You can't hold it down. And so that is why I am incredibly interested at this moment in time, right here, right now, because I think we're getting very close to the point where growth implodes. We've already seen 2 quarters of negative GDP in the US. We've already seen housing rollover. We've already seen supply chain issues ease. We've already seen most commodity prices fall 50%. We've already seen the dollar explode higher. The dollar's hugely deflationary because the largest exporting nations in the world, Japan, Germany, China, have all seen their currencies decline massively. So they're now selling finished goods at much lower prices. So the macro turn is very close. When we look at on-chain analytics, we start to see things that only ever happen in these massive bear market sell-offs, the 2014 sell-off, the 2017 sell-off, stuff like that. We also are at the bottom of the logarithmic trend channel, 2 standard deviations oversold. That's usually a good one. We're at the 5-year exponential moving average. That level has proven to be about the best risk reward you can ever find. Things like, if we use technical analysis, things like the RSI are as oversold as they have been at the bottom of every other cycle. So we've got this massively oversold crypto market at the time where the macro narrative is at peak. Everyone's like, inflation's going to be 20% forever, and Europeans are going to be dying in the streets because there's no food, and they're going to, they can't afford to heat their houses, right? That's the narrative right now. Okay, so how much worse can this be? And any rate of change means that the risk reward of digital assets from here, normally when you get to this confluence of events, the risk reward is somewhere between 20 to 50x. Now, it depends where you are on the risk curve, which is going to ask the second part of your question, Mark. So Bitcoin is the least attractive asset because it has least attractive of the major assets because it has more stability, further network effects. Therefore, as you get further network effects, your growth comes down over time. So, where would Bitcoin go in the next cycle? Who knows? But let's say 200,000. But then we look at the network adoption effects in Ethereum. How many people are building on the Ethereum network? The ability to now get yield on the network. What's that going to mean for DeFi? Who's going to build DeFi on top of this new kind of benchmark yield rate that's coming out of this? All of the people who are building NFTs, all of the stuff going on. Okay, that's mainly happening on Ethereum right now. Great. Ethereum's slow and Ethereum's expensive. So the market will seek the path of which they can get more stuff done at a faster pace, and they will make trade-offs. Trade-off is decentralization versus speed and cost. So when you move out the speed and cost curve, you basically arrive at Solana, Avalanche, Algorand, there's a whole bunch of these layer ones. So, then you start splitting out those assets and say, okay, how do I differentiate? And it's quite difficult, unless you're a technologist. But basically how I perceive it is Solana seems like it wants to go for the masses and create these kind of onboarding experiences, front ends. They've got a mobile phone, they've got amazing NFT marketplace. They seem like they want to get involved in the public. Then you've got Avalanche, and that seems to want to be more technical. We've got these subnets, you can do your things, it's a bit more technical, and we can probably financialize real assets on it. That seems to be their narrative. Algorand, somewhere like the financial marketplace, stuff like this. So I just look at these and say, okay, what we're going to see is the market probably, Bitcoin underperforms, Ethereum next, whichever one of these, and I don't know which ones, will do pretty well. And then there'll be new tokens of which we don't really know yet coming in that solve more problems, where you'll see the 1000x upsides that we've seen in past cycles. And then there's a bunch of shit that goes to zero. Well, it doesn't go to zero. It just, goes up and down with the speculative hype flow. So that's kind of how I'm seeing that. So in the asset management side of what I'm doing, we're going further out the risk curve now, finding people who are taking those bets, because those bets are going to be more important drivers of returns than ETH or Bitcoin over time.